All right, well, good morning, everyone. Welcome to AllGen's quarterly update and market review. Today is January 16th, 2025, the first webinar of the year for us. Happy New Year to all, and going to be an interesting one, as it usually is. Never a dull moment. So we're excited to get going this year. Wishing you all an amazing 2025. But in light of a new year, a new quarter, we want to share some thoughts of what we see happening economically and what we are doing as a result of what we see happening. So that being the case, the quick agenda for today. As you guys know, we like to get you guys engaged a little bit in the front end and the back end. So we're going to start with a couple of polling questions, and we're going to do a market review and outlook, which is what Jason's going to, again, share his thoughts on what we see happening. Then we'll give you some updates of what's going on here at AllGen. And then at the end, we will answer any questions that you have. So as you know, unless it's your first time here, please feel free as questions come up to type them in. You can type them in, as you can see on this next slide, at the bottom at the Q&A section. You can raise your hand. That's turned off so that we can go through the presentation. There is a lot of information that Jason usually shares on these webinars, but we promise we will get to every question by the end of the webinar. So we'll save questions to the end, but please feel free to type them in as they come up, and we'll be paying attention to those. Okay, so that being the case, let's kick this off, and we're going to start off with a couple of poll questions. We usually do a fun one and a not as fun one. So number one is, how do you feel about the economy with the new administration? Okay, there's a lot of unknowns. We have a big change in this country. Do you feel confident? Do you feel anxious? Or are you thinking about moving to Canada or some other country? I laugh, but I've actually heard that from some people. So just take a second there to just quick, no thoughts. It's a light question just to see where you're at. We'll give you a couple of seconds to fill that in, and then we'll see where people are at. So let's go ahead and see the results. Okay, the majority feel confident, but there is a minority of folks that are anxious about the economy with the new administration. So we'll see how that goes. Was that?
No one's moving.
No one's moving to Canada. Good. We don't want anyone leaving. Okay. All right. Very good. So let's get onto the next question, which one, we can't control the economy, but we can learn about things about the economy, which is this question: which current financial topic do you find most intriguing right now? Okay, interest rates, which aren't really rising, but right now they're kind of just staying steady, not moving in many directions. Inflation and its impact on everyday costs, the state of the housing market, okay, or trends in cryptocurrency and digital assets. So which one of these, if you were to pick one, would you be most interested in learning more or hearing more about? Give you a minute on that, or a few seconds, actually. Okay. So survey says, okay, the big winner is inflation and its impact on everyday costs, followed closely with crypto and the state of the housing market. No one really cares about interest rates, which is fine. Actually, one person does, so I shouldn't say that. All right, that's good to know. And we take these seriously because we actually include this type of information in these webinars, and you probably hear some about it, our thoughts about that today. So thank you for answering those questions. And without further ado, let's jump into it. Jason, take it away.
All right, thanks, Paul. Welcome, everyone. Excited to go through all these 47 slides I have today. I can jump right in. All right, so just kind of looking at a review of 2024. Kind of similar to a trend over the last 5 years, the S&P 500 led again. So large U.S. stocks were up 23% for the year. And then the S&P 600, the light blue line here, which is considered U.S. small cap stocks, were up 10%. And then you had international up 7%, and then bonds in the year up 1%. You can see, a lot of changes throughout the year, pretty steady for large caps with some dips along the way. But you can see a little bit of a difference that started happening. This was kind of right around election time. So you had both stocks, small caps especially, shot up really fast. Large caps went up during that time. But then you can see international really went down afterwards, and bonds went down afterwards. So we'll get into why that is as we go into the webinar here. Just kind of looking, not quite where, zooming in on where I put that vertical line, which was kind of right around here. But you can see just the fourth quarter, things started. So we had a pretty strong year, but then fourth quarter got a little rocky. At first stocks went up right after the election, but then they kind of came back down a little bit. The S&P still stayed up 3% for the quarter. Small caps went up a lot, or as high as almost up 10%, but then came back down to zero or flat. And then you can see bonds really took a hit in the fourth quarter, and we'll get into the reasons behind that. And then international really struggled in the fourth quarter, down 8%. So from a sector standpoint, here's what did well for the year. Communication services, and mainly that would be like Meta, Google, that makes up about 40% of that area, was up 33%. So they're the best performing. Financials actually started doing better. Financials typically are more profitable in a higher interest rate environment. But at the same time, in a higher interest rate environment, not as many people are borrowing, because you kind of had a little bit of that sweet spot last year with interest rates coming down some. And then consumer discretionary up 25.5. The S&P again was up 23, technology up 20. And then you see on the downside, materials didn't do well. Now, interestingly, gold, which I'll point out, was up 27% for the year, but other commodities and other materials were actually down for the year, which would show that that was deflationary for a lot of those areas. And I'll touch on that in the inflationary section of the webinar. But healthcare, real estate, energy, really were pretty much flat on the year. And then even your staples underperformed as well. All right, so once again, we had a year other than 2022 where value really outperformed. 2024 has been similar with the theme over the last really 5 or 10 years where growth just continues to outperform. And so if you are a value money manager right now, you are not liking things very much, where growth stocks, mainly tech stocks, are significantly outperforming kind of your traditional, not just your traditional value names, but stocks that would be considered cheaper based off of price to earnings or price to cash flow, kind of the Warren Buffett style, trying to find really good deals. That's been an area that hasn't done as well. Still not bad. I mean, if you look at for the year, up 12%, but when you compare it to 36, certainly not as good as growth. And so I point out this next chart just as a kind of a little bit of a cautionary piece, really focusing more on the right side here, where you see what is this is the weight of the top 10 stocks in the S&P 500. So back in the tech bubble around the late 90s into 2000, that was the highest point in history in terms of percentage of stocks, the high that they reached. I shouldn't say history, but like the last 50 years. The highest point that they got in terms of the concentration of the top 10 stocks in the S&P 500. But as you see here, as the NVIDIAs and the Apples and the Microsofts and the Googles and the Metas, they just continued to grow from really kind of 2018, 19 on, especially after the pandemic. This has now reached an unprecedented height of nearly 40% of the S&P 500 is made up of 10 stocks. From a market cap weighted standpoint. So that's typically that can come towards a peak. Like this was the peak right before the bear market in 2022. Obviously, this was the peak before the tech crash in 2000. But at the same time, I wouldn't use this from a timing standpoint, because you can have a small number of leaders continue to lead for an extended period of time. But it does explain some things. If you were in those top 10 stocks over the last 10 years, if you were overweight, you probably outperformed. If you were underweight, you didn't do as well. But it's also kind of just to be cautionary, if something happens to those top 10 stocks, and I kind of think of what happened a little bit during the late 90s. We started to break these up. Microsoft had a monopoly. There's a lot of kind of areas that broke down when those stocks got too big. The term oligopoly has been thrown out recently, and explaining, just a few stocks that are really just dominating the market. And while I haven't seen anything, that's really worth mentioning about breaking up any of those stocks, it's just something to be cautious of. Not trying to be doomsdayer here, but just saying something that we want to watch out for as we go forward. So, from like an earnings standpoint, and that's a big driver of stocks, is our earnings growing consistently over time. And so that's really, if earnings are going up, it's usually a pretty good sign for stocks. And as you can see here, over the next 2 years, earnings are predicted to grow at 15% and 14%. So that is definitely very healthy, as you can see it compared to the last like 20 years here. Last year, just for some comparison, the earnings grew at about 9%, 8.7 to be exact. And most of that was actually from a margin increase. So that's companies really running much more efficiently. Not a lot of that came from revenue, and really share count decreased. So there's a lot of companies buying their own stock back. So that could have pushed it up. But if you think about how well the market did this past year on 9% earnings growth, and if this is a big if, because this is just a prediction, but earnings grow at 15% and 14%, I would put that on the bullish side of kind of the scale when you're measuring the market and looking at it going forward. That would be supportive of higher stocks. All right, so on the other side of the scale, what to be careful for. I mentioned the concentration of the S&P 500, but this looks more at valuations. And so this chart right here is really looking at the chart of really the forward PE for the S&P 500. And the forward PE is kind of one of your typical measures of valuation. But at the same time on this chart, you'll see actually 6 different valuation metrics. And every single one of them shows that we are over our 30-year average in terms of evaluation. Some of them, most of them are like the PE, forward PE is 1.3 standard deviations. Price to cash flow is 2 standard deviations from a 30-year average. So this would tell me that the market is expensive. And even the earnings yield spread, which kind of measures the earnings yield of stocks versus the yield of a bond, is negative. And when it's negative, that typically says bonds are more attractive. And from an historical measure, that would say that. So just something that we're watching. You can see this was the high before the 2000 top in the bull market of tech stocks, when after that markets came down, and obviously valuations came down as the price comes down. This was the high right before the 2022 bear market. So you can see that, and then we're pretty close to essentially another 50+ year high, because this was the highest point in a long time over here. So again, this is just one that I would put on the scale of, hey, this is more cautionary. You got to be a little bit careful when valuations get expensive. Doesn't mean that stocks can't continue to go up. It just means there's a little bit more risk involved. Now, when we look at it from a sentiment standpoint, and we're using Ned Davis's what's called their crowd sentiment poll, which basically takes multiple sentiment measures and kind of combines it into one. Somewhat positive and negative. On the negative side, we were at an extreme optimism, which is bearish. And this is a contrarian sentiment, is usually contrarian. So the theory is when people are overly bullish, they've probably already bought into the market and there's no more cash left for them to buy. And so from a supply demand standpoint, if your supply is your stocks, and then your demand is cash buying into stocks, if you have no more cash and everything is in stocks, then there's a lot more supply and a lot less demand. And the same thing on the opposite side. You can see after the pandemic, when you hit that low, you had extreme fear or extreme pessimism. The exact opposite. When the people are extremely fearful, they've probably already gotten out of the market, meaning there's a lot more cash that could go into the market. So I point this chart out. We just recently came out of that extreme optimism. When you see here, when it's above 66, markets on average, their percentage return per year is a very flat 1%. So markets typically don't do well over the long run when there's extreme bullishness. Now we've come back down into this next level. So coming from above that 66 to this 57 to 66 range, markets have returned around 4% in this time frame. So still not great, but at the same time, not as bad as if it's extreme optimism. One other sentiment indicator that I'm pointing out here. It's not one that we reference much, but it's one that I've watched over time that usually is a pretty good long-term indicator, not a great short-term indicator, but a good long-term indicator is when, well, basically as stocks as a percentage of financial assets. So basically, what percent of your overall wealth is made up of actual stocks? And you see it kind of peaked in the late 60s at about 30%. And that was right before a very difficult time in the market, really where the market didn't do much at all from point to point. From 1966 to 1982, the market was essentially flat. So, and then you had the tech bull or the tech bubble, excuse me, where, your equities hit about 31%. And then right now we're at pretty much an all-time high, or at least as far back as this chart goes, where almost a little over 36% of your population has their money in stocks compared to their overall assets. So again, from a contrarian standpoint, that would show that historically when those get high, it's not good from the long term. Again, this is a difficult one to time immediately, and I'm not saying sell everything, but it's just something, again, we kind of use a weight of evidence approach. This is one we put on the side, the cautionary side. All right, so kind of transitioning a little bit over to the international side. While US stocks are expensive, international stocks are the opposite. They're from a discount in terms of kind of the valuation of international stocks versus the valuation of US stocks. We're at like a 50-year low in terms of international stocks being cheap compared to US stocks. So that is, something just to point out from the standpoint of right now, international stocks are cheap compared to US stocks. And I saw one chart, I don't have it in the presentation here, where it showed that a specific section of international stocks, European stocks, are at all-time lows from a valuation perspective. Now, just because something is cheap doesn't necessarily mean you should buy it. But it is one indicator that we want to look at when we look at to see where we should put weight in the portfolio. On the right side here, though, this is an important thing to factor where, again, at the beginning of the presentation, I said earnings are very important. Profits are important. So you typically want to put your money where profits continue to grow. And so this is looking at profit growth, globally, focusing in on a couple of the main areas of the world. And you can see US has just shown a dominance in terms of earnings growth. And you can see China, really since kind of 2018 or so, has not been growing their earnings anywhere near. I mean, they've been going down. It started to look a little bit better over the last year or so, even though there was a little dip here at the end, whereas US stocks continue to go up. And even some of the other international areas, Japan, Europe, emerging markets, they started to grow again, which was encouraging, but you can see this small dip here towards the end. So you want to go where the earnings growth is. And so that's definitely in the US, but you also have to weigh that with, and that's probably why US stocks have been a lot more expensive. So just want to be cautious there that yes, US stocks have been growing well as their earnings, but they're getting expensive. International stocks are cheap. Now we're still slightly underweight international because we'd like to see both earnings growth and cheap. And you don't have the earnings growth side of things. Plus, there's a lot of political issues, geopolitical issues going on too that we have to be careful of. So still overweight US stocks in our portfolios. Now, a big concern for the general market and for a lot of people, and you hear a lot on the news, especially with the Trump administration, or particularly with the Trump administration entering, is the talk of tariffs. And so, we pointed out this chart because this kind of dashed line right here is what Trump is proposing he will do from a tariff standpoint. These are looking at the tariffs globally. Over time, you see over time, tariffs have really reduced significantly. This is Trump's first 4 years in office right here. You can see that tariffs did go up, but this is what he's proposing right now. And so we point this out to show you why, you see that in the headlines that, hey, this could be a big deal. This could add to inflation. This could hurt markets. And definitely the market has been a little bit concerned about that. I will point out though that if you've studied Trump at all or studied any of his negotiating tactics, he usually comes out from a very strong position and then backs off. It's a negotiating tactic. So we don't really believe this is where tariffs will end up. But we did want to point out that this is a concern. And even if you end up right here, it's still increasing tariffs. And just to kind of further expand on that a little bit, just so people understand some of the mechanics behind it, it's not like other countries around the world don't have any tariffs on American goods, and then we're just going to go add tariffs. No, other countries have significantly high tariffs, and we're bringing some of our tariffs up to where theirs is, just to put a little bit of context behind it. But from a market point of view, tariffs could add some inflationary concerns, and I think that's particularly why bonds started to one of the reasons why bonds took a hit and interest rates started going up. There was a little bit more fear of inflation coming back if these tariffs were high. So, this is kind of looking at still from an international standpoint, but at the same time, and kind of back to that other chart too, just one thing I forgot to point out, not just from an inflationary standpoint, but if you have really high tariffs, you could also potentially cause international stocks not to do well too. So that could be a factor if you're investing on an international standpoint. But one of the going back over to the other side of the scale, a positive, really globally, but this kind of makes the point more from an international front, is that this is showing if central banks around the world are cutting rates. And when central banks are cutting rates, what's called easing, that is more stimulative. And so typically markets do well in a more stimulative environment. Markets tend to not do as well when central banks are starting to raise rates. You can see in 2022, when markets fell, they were raising rates. So, but right now they're easing. The majority of banks or central banks around the world are easing. So that typically when you're above 50% of central banks around the world easing, you have an 8.4% annualized gain on the all country world index, which would be basically investing in the whole world. It's the stocks around the world. So that's a good thing. And that would be supportive of a stronger market and a stronger economy. All right, so this is a chart of the U.S. dollar. We point out the dollar because it plays plays into a lot of factors. It plays into factors from an international standpoint. It plays also a factor from an inflationary standpoint. There's a lot of things that are important to track the dollar, and there's ramifications for either a rising dollar or a falling dollar. You see a lot of kind of emails and things out there, media, how the dollar's crashing, kind of doomsday type of stuff. The dollar is definitely not crashing. It's been very strong. It had a very strong 2024. And the thing I point out here is you can see kind of right towards the election time, from really the fourth quarter in general, the dollar really started to strengthen quite a bit. One of the biggest factors of what causes the dollar to go up or down is interest rates. And so if the perception is either interest rates aren't going to go down as much, which is kind of the perception right now, or interest rates are eventually going to start to go up again, then the dollar is going to get stronger. Whereas if the perception is interest rates are going to start to fall or fall more than what the market expects, then you'll start to see the dollar, or any currency for that matter, weaken if interest rates of that country start to go down. So this to me is an indicator that interest rates are probably not going to come down as much as what the market was thinking, especially as we went into the fourth quarter. And we probably should be on the lookout potentially for inflation to come back. Part of this, I think, goes back to some of the fears with the tariffs. But I also think another factor is there is some economic indicators coming in that shows the economy is really not as weak as what people were fearful of, and the economy is starting to strengthen again. And so if the economy is starting to strengthen again, then the Fed probably won't have the ability to continue to lower rates. especially if inflation is not dropping, which I'll touch on that here in a second. All right, so what's interesting though is while the dollar is getting stronger, so is gold, and that's very rare. Usually, you buy gold as a hedge against the dollar, or said in another way, as a hedge against inflation. And so, but they're interestingly, they are both going up together. At some point, they're probably going to diverge. And I'm not sure which one, no one knows the future, right? And which one is going to diverge. It's going to be the dollar getting weaker, or is it going to be gold getting weaker? We've been slightly overweight gold in our portfolios, and that has been a good thing for our portfolios, as gold was up 27% for 2024, which was actually higher than the S&P 500. So gold has done really well. There's a lot of reasons to own gold. You know, an inflation hedge, a fear of difficult times, geopolitical risks. You know, there's a lot of different reasons to hold it, and that has been a lot of those reasons are the reasons why we've held it over the last, really since 2019. But you know, that's something that we have to keep an eye out, is if the dollar continues to get stronger, then you know we gotta see if we need to maybe pull back a little bit on the gold. So, all right, well, as we kind of continue to look here further areas of the economy, we can see this is a chart on inflation. So we're looking at the CPI and the PCE, two of the main measures of inflation. The Fed focuses a little bit more on the PCE, but the general market kind of focuses a little bit more on CPI, both important to track. You can see that they definitely all come down from their peak and come down a pretty good amount. However, the Fed wants to see it get to a 2% target. And you see the most recent one to report was the CPI, which I believe was actually yesterday, came out, and core CPI was still about 3.2, I believe, right here. And it started to, the headline number actually came up as well. So while they have been going down, they've started to flatten out. Now, the number yesterday caused markets to go up, and bond prices went up and yields came down, because even though the core CPI coming in at 3.2 is still above this 2% target, I think a lot of people were fearful that inflation was going to be a little bit stronger than the readings that actually came out yesterday. So the market was a little bit relieved that it didn't, and the month-over-month number was only a 0.2% increase, which was, you know, if you annualize that, which I don't like to do, that's 2.4. But so that's encouraging. At the same time, it's still got a ways to get us to go below or even to that 2%. Now the Fed's saying, and they've already lowered interest rates last year 1 full percent. But what they're stating is that they're not going to necessarily wait for it to get to 2% to lower rates if they feel like the economy is starting to slow at a rate that is not good. So they actually have already lowered rates. The key factor here is, do they continue to lower rates with it still not getting below that 2% target, and some of the economic numbers already coming in stronger than what was anticipated. And I think that, again, that's why interest rates have come up in terms of market rates have come up, like mortgages, you know, treasury bonds, those interest rates have come up quite a bit recently, is because of that thought that the economy is starting to strengthen. Inflation's not getting down to that 2%. It's not fully coming down to where it needs to be. And, you know, potential tariffs are coming, things like that. So that's, I think, why the market pulled back over the last month or so, were some of those fears. All right, so one of the key pieces to watch in inflation, there's really two key pieces. There's what's the housing market doing, and then kind of what are jobs doing. That's kind of two of the big components of inflation that you got to watch out for. And so this is the owner's equivalent rent. All that essentially means is, like, if you were to rent your home, what would be the rental value of your home right now? And this is measuring on a year-over-year growth standpoint. You can see right after the pandemic, this measurement for housing went up a lot, and so rents went up a lot, mortgages went up a lot, and got up as high as to an 8% standpoint. The reason why it's important to track this is the biggest, you know, part of the pie when you look at what you spend on a monthly basis. It's mortgage and rent typically. So encouraging thing is that has been coming down at a very good clip recently, and in fact, it started to accelerate over the last few months. So that is encouraging. However, it's still at like 4.7%. The 5-year pre-pandemic average was 3.2, which is this dashed line. So you still have a ways to go here before that fully normalizes. And so that's what we have to kind of look at when we're looking at from a housing standpoint. Is that going to relieve the consumer? Are people going to be able to afford rents? Are people going to afford to be able to buy a home? That's a big factor. So the other piece is the job side of things. And this is a chart that we've been pointing out a lot, because another big factor of inflation is wage inflation. When people's wages are going up, they spend more. And when they spend more, that causes inflation. So we're looking at two lines right here on the left, and this is job openings, meaning companies that have job openings that are looking to hire, and then you have total unemployed right here. You can see right after the pandemic, big spread. There's almost a 2-to-1 job openings to people looking for jobs. That's almost reached parity now. So that means that people are not that wage growth is not growing as fast as what it was. There's not that pressure on companies that have to raise wages to keep their employees. But the big part of that is, two, job openings going down, but at the same time, unemployment going up. You can see if we zoom in on this last section right here, this is the total unemployed. So you can see that has increased and hit a new kind of 4 or 5 year high right here at 7.1 million. Not that we're cheering for people to become unemployed, but from an inflation standpoint, you want to see kind of a little bit more parity right here to kind of tame inflation, if you will. Now, one other kind of thing to point out on the wage side of things, the wage inflation side of things, the job market, is that this is showing a chart of people quitting their jobs, the gray line, and then companies laying off. And so, right after the pandemic, when you had wage increases very high, wage inflation very high, you had a lot of people quitting their jobs because they're like, hey, my current employer is not paying me, what I can get at this other company. I'm going to quit and go to this other company so I can earn more money. But you can see now that unemployment's gone up, now that not as many companies have job openings anymore, that the quit rate has gone down significantly. Still not to where we were pre-pandemic, but it has gone down significantly. So people are not less confident that if they quit their current job, they can go find a better paying job somewhere else. On the other side of things, layoffs, which are still actually very healthy and way below pre-pandemic levels, have slowly started to creep up. So nothing to be concerned about, we don't believe, but it's just something to point out here. The quit rate is really the one that we're watching that's telling more of a picture that people aren't as confident that if they leave their job, they're going to be able to go find a better paying job. All right. Another part of the economy that we want to touch on here is looking at kind of the manufacturing and services. That's two kind of big ways to measure any economy. In the US, services are definitely a much bigger part of the overall economy than manufacturing is. And so, but they're both important to track over time, because if you go below 50 on this line, then it shows that it's contractionary, indicating kind of recessionary. And you can see manufacturing, has gone down below that 50 line. Now, I did use a 12-month moving average on these lines to kind of smooth them out a little bit. The encouraging thing that we are seeing is this moving average, or the trend, is that both of these, even though manufacturing is still contractionary, both of these are trending higher. And so that's a big reason. And now it seems odd, but I think that's the reason why kind of the market came down a little bit recently, because the economy is getting stronger. And now that sounds like total opposites, because usually when the economy gets stronger, that's good for stocks. But when the economy is getting stronger, that also means that the interest rates, the Fed won't be able to cut rates as much, and that inflation could potentially go up again. And that's been the big fear recently. So this is an important one to watch. You do want these to go into expansionary, both of them, to have a good, strong economy. But at the same time, you have to kind of keep track as our price is overheating, our price is getting more expensive. And so we have to watch both of those. Now, kind of transitioning to the bond side, fixed income side of the presentation, you can see the Fed funds rate, which is where the Federal Reserve kind of determines the short-term borrowing rate, that hit a peak up here at like 5.25 to 5.5. And you can see it ended the year down 1 percentage point to 4.25 to 4.5. Now, the dashed red line is the Federal Open Market Committee, called FOMC. That's what they're projecting. And then the dash line here is the what the market is projecting. And it wasn't the case last year because those were predicting two different things. But for this year, both of them are actually kind of projecting 1 to 2 rate cuts through 2025. And so in the first one, most likely would be right around the middle of the year. And right now, the highest probability that I checked this morning was that we only have one rate cut, but it's not, there's still a lot of data that could come in over the next 6 to 12 months that can certainly change that. Now, here's where they start to differ. When you go out a little bit further, market expects that we're not going to be able to lower rates further from that, whereas the Fed is projecting we continue to lower rates slowly over time. The FOMC projection would be a little bit more helpful from a market standpoint, more stimulative, whereas with the markets thinking that's a little bit too rosy, and there may be inflation may be more of a consideration. We won't be able to lower rates, is what the FOMC thinks right now. So this is a really busy chart, but if you kind of focus in on this dashed area here on the left, this is looking at what bonds are paying from a yield standpoint right now. And so the blue diamond here would be what they're currently paying. So like US Treasuries are currently paying 4.6%. And then the 10-year median of where, over 10 years, what has been the median of interest rates for a 10-year Treasury is 1.9. So, I think bonds right now are very unloved. And obviously they went through their biggest bear market of all time in 2022 and went through the worst 3 years ever, kind of from that, into 2021 to into 2023. But that's already happened. And now interest rates are much higher. And on your bond side of things, even if the price of your bond goes down a little bit, and Treasuries, you're getting paid 4.6%. Municipals, the tax equivalent yield, and now this assumes that you're in the highest tax bracket, is 6.6% compared to 4% as 10-year median. But even like investment grade corporate bonds, 5.5%, mortgage-backed securities, 5.5%. So you see all of these are right around 5.5%, where historically they've been closer to 3%. So in your bonds, you're getting a lot more yield right now. And that provides.
Hey everyone, this is Jason. Just to give us a second here, the power of our whole building went out, so we're just getting back online. We'll be joining the presentation back here in about 30 seconds. Wow, guys, that is an AllGen first for our webinars. We lost power to our entire building, and the backup generators have come on, and only some offices have power, so I had to change offices here. But if you can hear me, Paul, and you can still see my screen, I'm going to just continue on. Show must go on. So let me just hop right back in here. And thanks for everyone who's sticking with us. That is an AllGen first, like I said. All right, so I think I was talking about bond yields. Jumping back over there, all that to say, kind of sum this slide up, is that bond yields are at a near kind of 30-year high, 30-year high. And so they are attractive. And so while returns for bonds haven't been great for a long time period, they definitely look a lot more attractive going forward. So we are still underweight bonds because it does look like yields may go up, but I definitely wouldn't eliminate it from your portfolio, where some people may be tempted to do that. So anyway, we do think we're going to find some pretty good opportunities as we get through the year. And if we do see, kind of treasury yields get back up above 5, that may be a point where we start to get a little bit more kind of weight bonds a little bit higher. So right now, again, we said we're underweight slightly bonds, but that's where we would look at to take advantage of it. We think we may get that opportunity this year at some point. So, all right, let me go to this next slide here. So just in general, in 2024, most bonds were actually up. You look at high yield corporates up 8.2. You look at emerging markets up 6.6. Money markets did 5.3. So there were some bonds that definitely did well. What didn't do well was longer term treasuries. They were down 8.1%. In fact, the price was down about 13, but they paid a yield close to 5. Short-term treasuries still got about 0.6%, and munis did 1.1. So another chart here that just to point out from the standpoint of looking at the consumer is that during the pandemic you had some really crazy things happening. You had a lot of stimulus, and people were spending a lot. So you had like durable goods up 7%, but and then in 2021 up 17%. When people were getting stimulus checks, they were spending a ton. When everyone was locked down, services were -6 because no one was going anywhere. But that came back strong in 2021 and over the next few years. The reason I point out this chart though is just to kind of show that it's really normalized a lot more, where you see here 3%, 2%, 3% in terms of all the different areas to spend on, kind of going back to where we were in 2019 pre-pandemic. So you do see the market normalizing a little bit more, which we think is a good thing. All right, so looking kind of at the health of the consumer, this was one thing we were a little bit concerned about last year especially, is that delinquency rates, meaning when people can no longer pay for and they start missing their bills and not being able to pay their bills, specifically these two right here, credit cards and auto loans, started getting towards a 10-year, actually 12-year high. That's usually not a good sign, but it was encouraging to see that in the kind of towards the end of last year, you start to see credit card delinquencies roll over and come down a little bit. So maybe they ended up peaking here. It's still too early to tell, but that was an encouraging sign. You can see mortgages here are still very healthy from a long-term perspective. I would just not even look at student loans because there was a moratorium there. So they didn't even start. They're going to start collecting data on that again this year, and we'll track a little bit closer, but it's pretty much a meaningless number at this point. All right, kind of get towards the end of the presentation, you can see that this is the federal deficit in net interest outlays. So if you look at kind of our deficit, when I say deficit, you look at kind of tax revenue brought in versus government spending. The deficit would be the difference between those two. And we've been running obviously a negative deficit or we've been running a deficit for a significant number of years. However, if you look here, kind of the 70s through early 2000, the deficit was kind of maybe around that -3% average. And you can see after the pandemic, when we started printing a lot of checks and just sending people money, the deficits got super high and the government slowed down, the economy got weaker. But right now going forward, it's still around this 6-7% mark, and that is something to be definitely concerned about because that's not really sustainable over the long run. And you see the blue area of this is the net interest outlays, and this is an area where high interest rates can really hurt an economy. A government, because now we're having to pay, the government's having to pay, and we through our tax dollars are having to pay on amount that we're borrowing. If the government is using treasuries to raise money, then now they're having to pay almost 5-6% on treasuries. So 4.6 to 5% on treasuries. So that becomes a bigger and bigger portion of your deficit, and that's concerning, especially if interest rates continue to go higher. And that's a big part of our deficit right now. So if we look at it from a GDP standpoint, meaning, GDP, the total amount of goods produced for an economy. That's usually the way you measure if an economy is strong. But if you take the GDP and you divide it by the debt, a high debt to GDP, actually debt divided by GDP, that we're reaching all-time highs here. So the all-time high was reached right after World War II at about 110%. We're kind of at that 98%, but we're predicted to be up here towards 120% by 2034. So that's concerning. That's not something you would like to see over the long run. So that's something that we'll be watching for. It's not something that you say, hey, sell everything, the market's going to crash, because you can have a country like Japan that has a 200% debt to GDP. So, it's not. It's just something we got to be careful of that, because that can slow down a country significantly, and it makes it more difficult for your GDP to grow. So I want to kind of finish the presentation just more from a timeless kind of lesson standpoint, saying that from an investment philosophy standpoint, we try to manage risk really well. And when we try to manage risk, what we're trying to do is, if the market goes down a lot, we're trying not to go down as much. And so I bring up this simple chart here that shows if you see the market drop by 10%, then it takes 11.1% to recover. Let me go over here a little bit further to the right. If your account drops by 50%, then it takes 100% to get back to where you started. And to take it the furthest extreme, if your account drops by 90%, it's a 900% increase just to break even. So that I'm trying to make the point that it's really important not to lose big, because it just takes so much more on the upside just to get back your losses. So we always try to really strive to manage risk really well in our portfolios. Now, this is just a simple little chart. Hypothetically speaking, if you were to build a portfolio that captured 95% of the upside of the market, but then only captured 90% of the downside. So what that means in numbers is, if the market went up 10%, you would go up 9.5%. If the market went down 10%, you'd only go down 9%. So if you could do that successfully over time, which is easier said than done, but if you could do that, then this dark blue line right here would be what those returns would look like if you had a portfolio that did that compared to the S&P 500, meaning making 95% of the upside, but only losing 90% of the downside, versus just investing in the S&P 500. You can see that significant outperformance over time. 100,000 back in 2005 would now be worth 845. This is an older chart. It goes back to at the end of 2023. That's where you would be, versus 364,000 in the S&P 500. So, again, that's easier said than done, but that is the theory behind why we try to manage risk really well. You don't always have to make as much on the upside to do well in the market. As long as you do pretty good on the upside, but you do better on the downside, you can outperform the market over time. This is looking at our balanced portfolio right now, where it stands, and these numbers fluctuate over time, but just in general, our portfolio captures right now, our balanced portfolio compared to a balanced benchmark would capture about 94% of the upside of the market, whereas it's only capturing 77% of the downside. So again, if the market was to go up, or the balanced benchmark was to go up 10%, you'd go up about 9.4. Whereas if the market was to drop 10%, you would go down 7.7. So that's what we want to see when we build a portfolio, is that over time, we lose less on the downside, we do pretty good on the upside. Now, when you go through a strong market like last year, that means, let's just say, for example, the market went up 20%, you may have only gone up 18 or so percent. So, sometimes people don't like this type of strategy when markets are really strong. And so in a market like last year, we may underperform on the upside, but over time, it's usually a really good portfolio if you are able, which is a key if, to protect well on the downside, but still do pretty good on the upside. So I just think it's important to point that out so people understand our investment philosophy and why we try to manage risk so well. So wrapping it all up on my end, and I'm sorry that it went a little bit long with the kind of the downtime there, but just to sum it all up, although there are some signs of weakening in consumer finances, there's been some normalization with consumers, and they are supported by a stronger labor market. And we expect the economy to continue to grow at around 2.25% in 2025 from a GDP standpoint. And while U.S. stocks valuations are expensive, excessive optimism may have peaked. And at the same time, we expect earnings and profit margins to remain supportive of stocks. Kind of the fly in the ointment as we go forward will be inflation and yields. That's why we're watching those so intently. International stocks, while they're cheap, they're still dampened by ongoing and escalating trade tensions. And on the fixed income side, there are some attractive yields, and we do expect to find some pretty good opportunities in 2025. But even though right now we are slightly shorter duration on the bond side and slightly underweight on the bond side of our portfolio, as we expect volatility to remain high as the markets kind of parse out exactly how many rate cuts and where inflation is going to go. So bottom line, a well-diversified, disciplined strategy that holds non-correlated assets and the kind of the style that we do when we manage risk first will be your friend over time. You may not like it as much when markets go straight up, but over the long run, having that steady run in your portfolio is much better than that wild roller coaster ride. So if you have any questions, obviously contact your advisor about your portfolio, and they'd be happy to ask that. And with that, I'm going to hand it back over to Paul, and he's going to touch on some financial planning and AllGen updates.
Sounds good. Thank you, Jason. Again, as always, a lot of information, but hopefully valuable for our listeners. And again, we apologize. Obviously, we couldn't control the power outage, but here we are. I was told it was a decent recovery. So in that recovery, I know we lost a few questions that were there. They didn't show up again on my screen, even though we still have some that we're going to ask. We understand if you need to leave because we're coming up against the hour schedule, but we will still go ahead and answer these questions or address them or make, some of them are only comments. But what we're going to do is, again, if you do have those questions, if you're still on, if you want to retype it, we don't care if it's a dupe. We'll go ahead and go through those as I give you just a few updates on what's going on at AllGen. So, and again, additional resources for all of you guys. We do have a blog, which is at allgenfinancial.com/blog. So, which is shown here on the next slide. And then we also have a bunch of YouTube videos, so on different subjects, we try to be timely, tax code changes, as interest rates changes, that we try to do some videos that are timely, but also some, perennial, good financial planning principles as well. So feel free to go to our blog to learn more or hear some more resources that are there available for you. Okay, as well as some financial planning updates that we've got going on. Important dates, especially if you live in Florida. February 1st is a Florida prepaid enrollment opening. So many of you are familiar with the Florida prepaid program, which has changed a lot in the last few years, and a lot of people taking advantage of what that looks like, or what that could do for them if they have children or someone they know have children. So the enrollment period is from February 1st to April 30th. So we want to make you aware of that in case you weren't, because it only is a couple of times a year that you can actually enroll and lock in those prices. Also, tax filing extensions and deadlines. So actually, the deadline is for business taxes March 15th. That's without extensions, okay? And then personal taxes, April 15th. So those are coming up here shortly. Of course, again, these are unless you file extensions. And if you do own a business or just on your own personal, those happen to be deadlines for certain retirement plans. If you want to still get deductions for last year, that could be viable. Of course, we always say, please speak to your financial advisor to see if that makes sense for you in your particular circumstance. Another quick update that we have here is we have a new team member. So if you hear him, if you haven't already, or if you see him when you come into the office, please welcome Ethan. He joined us, local, native, kind of like Jason, born here in Florida. And went to UCF, and has a musical background, and I'll let him tell you about that when you speak to him. So he and his wife enjoy traveling together, especially to my hometown of New York City, but more the mountainous regions and northern United States. So please help us welcome Ethan to the team. Okay, so, and lastly, again, as I read some of these questions off quickly, and I'm going to really tell Jason to be efficient with it, because he can pontificate on a lot of his answers as he loves and is passionate about the subject. But feel free to ask any questions that you may have in that Q&A section, and we'll head that off now. So I have Cheryl. Always good to see you, Cheryl. She said that her bet is on gold since central banks are easing rates globally. especially China stocks close to U.S. stocks. Inflation will go up first quarter. Okay, so it's not a question, it's more what her opinion is on that. And I think you said it's hard to tell either way right now which way it's going with the new administration moving factors, but she's sharing that her opinion is that gold is probably going to go up versus the dollar as they've been going up together. Any final thought on that, Jason?
We haven't reduced our gold holding yet, but it is something to consider that as we look at it. If we continue to have an environment where rates look like they're going to go up higher, and without inflation going up too much. So we're watching a lot of factors right now. We do still maintain our overweight. So I think there's enough factors that keep us still on the bullish side of gold for sure.
Okay. And she did ask a question, a follow-up question to that, not to that necessarily, but what are your thoughts on the China economy?
Yeah, China still has their issues for sure. I think President Xi has not done a great job at creating a very stimulative, open kind of more. For a while, China was kind of going more and more capitalistic. They've kind of definitely pulled back significantly on that. So China has some also housing market issues, with significant amounts of debt. So that's, as we remember, kind of coming out of our debt crisis and the housing crisis, that took a long time to work through, and China's still trying to work its way through that. So, plus there's just such, from an investment standpoint in China, it's difficult because there's so much geopolitical tension, how they're a little, aligned with Russia and the Ukraine war and all that. So, we're really underweight China right now, even though it's something definitely to watch. It's the second biggest economy in the world, and it's not far behind the U.S. So it's something that we do want to watch, even if it doesn't mean we're investing so much in China, but for a global growth standpoint. But right now, China hasn't been that strong.
Okay, very good, very good. So let's see, another question. What are your thoughts on crypto? I guess we didn't really talk about crypto in the presentation, but that's, of course, an inevitable question.
Yeah, for sure. Certainly, it's been strong since the election. I think there's a lot of optimism among the crypto bulls that the current administration is a lot more favorable to it. The SEC chair selection seems to be more favorable on crypto. Bitcoin got all the way up to 100,000. It has pulled back a bit. We are open to owning crypto, mainly Bitcoin, because it's a little bit more stable. And in our portfolio, if we do, it would be a very small portion because this is a very volatile portfolio. Excuse me, very volatile asset. But up to this point, we manage risk first, and it's just such a volatile, high risk security that we'd have to have the timing of that just right with a good pullback. But from a favorability standpoint, from a perception standpoint, people certainly tend to like it going forward. But I will say sentiment is and optimism from that standpoint is not always an indicator that the price of it will continue to go higher. But I think it's definitely in a more favorable environment going forward.
Yeah, I think to echo some of your presentation, the volatility of it is what, keeps us a little cautious. And we are that, fabled tortoise, and the tortoise and the hare approaches. Usually the tortoise ends up winning, even though in the meantime you'll have high bursts up and high bursts down, and we try to avoid that from the hare. So Cheryl, thank you. You said excellent presentation. I won't repeat a lot of your comments, but we have read them. Okay. Can you please clarify a little bit more about the timing of buying real estate based on not, I guess they didn't understand the rent versus that slide that you did as far as rent versus cost or something like that.
Yeah. The tough part right now with buying real estate is that, interest rates have started to go back up again. You had a little bit of a reprieve of that kind of in the October, November, a little bit last year. There was some points in time where mortgage rates got down, to a reasonable level again, compared to where they've been over the last 3 or 4 years. So, a lot of people, when they buy homes, they have to do it with debt, with a mortgage. And so that ends up being a big factor. There is definitely some price, I wouldn't say price compression, but there's been some slowing of rent growth and slowing of price growth of real estate. So, hopefully for those who are looking to buy a home, you don't continue to have that runaway in terms of prices on real estate. That seems to have come back quite a bit. So in terms of timing of it, we're big favor. We're in favor of people once they're out of consumer debt, they have enough emergency reserves to own a home, and we help a lot of people buy homes. At the end of the day, hopefully, especially a lot of our clients being in Florida, real estate continues to appreciate. It's usually a pretty good inflation hedge. But I think at the end of the day, it has to come down to, doing your financial plan. Let's see what you can afford. Where are you at, in terms of having a strong foundation? And, at some point, you just kind of have to deal with the higher interest rates and if it makes sense from a financial standpoint.
Yeah, and that's a good segue into, what I want to close this out with. I know we focus this presentation a lot on the economy and investments, which is great. But at the end of the day, I heard many years ago Jim Rohn say, "Hey, I can't control the global economy, but I can control my economy." And that's what really matters. And to us, the way we do that is by doing financial planning. That takes a lot of time, and yes, it's work and effort, but it really helps us have a strategy for each individual person. It gives you peace of mind knowing that regardless of what's going on in the world, your plan is solid if you're taking it and by knowing the steps to take to get to the next level financially. So we want to encourage you to, at the beginning of the year, as we all have New Year's resolutions, or many people do, maybe a good New Year's resolution is to establish a financial plan for yourself, focus on the great things, or maybe review your financial plan, see where you're at, and what maybe you should be doing in light of all the stuff that Jason just finished mentioning. Please feel free to contact us. Here's our contact information. If you don't know it already, if you do know it, please feel free to contact us as well. Speak to your financial advisor if you want to update your plan. Let's welcome Ethan to the board. We hope this to the team. We hope this has been helpful, and we look forward to seeing you soon. Have a great day.
Yeah, thanks everyone.